Hello everyone, welcome again to another financial analysis video with myself, Moed Amin, and Ted Wayman. So the goal of this show or these episodes is to help people get much savvier and better at financial acumen and raising their financial understanding, so that you can look at a financial statement and understand what's going on in the business, whether you're selling to them, whether you're investing in that company or thinking about it, or even if you're thinking about working for that business. So in this show, we take on requests, most of them from our viewers, and we analyze famous names or big name brands to help people understand their finances. So today we're going to be looking at Accenture. Now, Accenture are a very large professional services firm, so in the region of probably above $50 billion in annual revenue now. And stick around because we're going to dive into that in more detail and help you understand their finances. But started out actually as a spin out from Arthur Andersen, which is a professional services firm. It used to be an incredibly large one, and now it's kind of gone bust. Started out in terms of IT consulting, but now Accenture cover a whole range of professional services consulting, from supply chain to financial consulting to sustainability and even marketing as well. So, definitely have grown in terms of their portfolio over the last few years. Now, quick look at on the shares actually, and we're going to actually come on to the shares later on. So stick around for that, because when we look at the finances of a company, which tends to be backward looking, retrospective, we also look at the shares, which in some way, which looks at the forward looking element of the business, but it's the kind of Wall Street and the financial community's assessment of their future potential. So we tend to look at those two so that you have a great context in your analysis. But looking at the share price, they floated in 2018. If you'd invested back then, you'd be sitting on a profit of about just over 75%. Not in the thousands as other companies we've looked at in the past, but 75% is not bad. And in the last year, if you'd invested a year ago, you'd be sitting on a loss of just over 17%. So stick around, as I said, towards the end, because we're going to actually look at that in context of the financial analysis. Now, this video did come as a request. And like I say, about 97% of the videos or the companies that we analyze actually come from requests from you, the viewers. So do leave a note in the comments section if you're interested in the company and its financials, and you would like us to analyze it for you so that we can help you better read those financial statements. So Guillaume, this is your video request. Thank you for making that request. So let's get to it. Ted, why don't we share with our viewers what we've uncovered about this company and help them better read the financial statements of a business like this.
Well, good to see you, Moed. Thank you very much. And welcome back to all of our subscribers, and welcome to anybody who is maybe new to this channel. And if you are new to this channel, please don't forget to subscribe, like and share, and also leave any comments you have in the comments box. Now, when you leave your comments, please do be polite. We not always get exactly right. There'll be people out there certainly working for Accenture who will know the business much better than I do. I'm just coming from the finances, and there's a few things that I don't quite understand as well. So if you'd like to kind of set me right on anything, please do so in the comments. So here is Accenture. We are looking at their annual report and accounts. This is available on their website. It's for the 12 months ended 31st of August 2021. So we're obviously now just after 31st of August 2022. So these will be quite out of date, and they will be expected to produce their next set of accounts in the next 3 to 4 months, I would expect. Anyway, so we're going to be looking at the numbers, and we're going to whiz through the kind of what they do and who they are and their corporate governance and who's on the board and all the blah, 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 etc., that you get in a set of financial statements. And we're going to whiz down to the kind of the key numbers, which is a little bit further down. Here we go, to the income statement. So they have been audited by KPMG. Moed mentioned that these guys used to be part of Arthur Andersen, which was one of the big 6, I think it was, when I was kind of setting out in my life. I qualified with Ernst & Young These guys were Arthur Andersen. They then split the consulting arm. They had a little bit of a battle over who kept the name. The Arthur Andersen audit company kept the name. These guys rebranded it as Accenture, and Arthur Andersen then decided to sign off the accounts on people like WorldCom and various other disastrous companies, and the rest, they say, is history. They went bust, basically because people just decided that their signature wasn't worth anything. So here we are. This is the income statement. We are looking at the revenues. You'll notice that the revenues are in so they're in thousands. So 50 so basically 50,000 million is 50 billion. So there's their revenue. So this is the what their clients are paying them for their consulting revenues. The cost of those services is basically what they pay to their consultants. So this number here, let's just move that up a little bit so we can see the whole thing. So this number here, there's the cost of what they sell to their what they pay their consultants to deliver on that revenue. So quite interesting. That's about the 32% a margin in there. That cost of services, it's about a 32% margin, which means that for every, I don't know, £100 or $100 that they're billing their clients, they're paying their consultants $70. And there's going to be a bit of a difference in there because the consultants, they have sick pay and sick leave and maternity leave, and they go on holiday and they go on training workshops, and they kind of have a bit of downtime and et cetera, et cetera. So all utilization is a big driver of these guys. Sales and marketing, general administrative, those are the overheads, cost of running the business, another 17%, giving them an operating profit, 7.6 billion, which is an operating margin of about 15%. Doesn't look too unreasonable. Little bit of interest expense, so they've probably got a little bit of debt sitting on their balance sheet. But still very, very profitable even after tax. 6 billion of profits, a 12% margin, very similar to the previous year. So very similar numbers to the previous year, but you'll notice that they are growing. So even in the pandemic, these guys straight online, clients having problems, they phone up Accenture, say, I've got a problem, can you come and solve it? And for a price, Accenture will come and solve it for you. So profitable company. 12% bottom line margin, net margin, looking pretty good. I'm just going to highlight this while we're here. So we don't often talk about this, but this is the earnings per share. So earnings per share, the basic earnings per share is the number is basically the earnings. That's this number up here. That how many shares are in issue divided into the earnings, the net profit. So it's kind of saying that if you own one share in Accenture, then of that 6 billion of net profit, 9.31 is yours. You're not necessarily going to get that because obviously some of the money is reinvested where some is actually paid out. In fact, it'll tell you that if you do own a share, you're going to get a $3.52 as a dividend, or that's what they paid out last time. And you can see the dividends have been steadily rising over the past few years. So nearly $3, just over $3 now, up to $3.50. And then we've also got this second number, which is the diluted number of shares. So this is after taking into account share options. So quite a big difference there. And the reason is that this company has a tendency to award lots of share options. Now, this is an important one for Accenture because it's part of their remuneration package to their employees. So if you work for Accenture, some of your compensation will be in the form of shares and share options. And that's a way that they keep people in the business, stop them leaving, because if they leave, they don't get their share options. So they keep their employees in the business, obviously reward their best employees with the highest number of share options, and then hope for an increasing price so that the consultants benefit from that. So it's very much the goals of the business are aligned with the goals of the investor. Very important that. But there is this diluted effect, and of course, if the share price is increasing, then you get lots of very rich consultants who can spend lots of money on wine and become a little bit like Chubby. So let's move on, and we'll come back to that. I'll reference that a little bit later on. So there's our income statement. The balance sheet, here's the balance sheet. Now, nothing really exciting going on in the balance sheet. We'll just point out, so we've got our non-current assets. These are the things that we need to run the business. So these are all these numbers here. You'll notice that, you know, there's not a lot of equipment because they just need a few laptops and phones for their consultants, and then off you go. What they do have is a lot of goodwill, and goodwill arises on acquisition. So Accenture has grown by buying other consultancies. So they'll say, oh, we need to get into this particular area here. Rather than developing the expertise in-house, we'll find an existing consultancy that's in that area and we'll just buy them out. We'll bring everybody, you know, within our kind of our arm. And you'll notice that's gone up significantly, suggesting they are buying companies. So it's gone from 7.7 billion to 11.25 billion between the 2 years. So it looks like they are growing, but they are growing through acquisition as well as organic. So those are the non-current assets. The current assets they've got up here. So this is the kind of cash and accounts receivable. Obviously, there's no inventory because, you know, they sell anything, they're consultancy. So, you know, they've got, you know, 9 billion of cash and 9 billion of you know, accounts receivable by their clients, about 20 billion total for their current assets. In terms of the liabilities, they do have a little bit of debt, not a huge amount of debt. So, you know, we can see there's a bit of a long-term debt, and then there's a kind of sort of short-term debt as well. That's not really a problem. Accounts payable, that's their customers who haven't paid them. What is interesting is this number here, deferred revenues. And we see that in both areas, both parts. So remember, the difference between current and non-current: current liabilities, amounts we owe and have to pay soon; non-current liabilities, things we owe and have to pay next year, the year after, and the year after that. Deferred revenues is basically their clients paying them in advance. So, you know, they've obviously got some deals with their clients, and they say, you pay us now, and then we'll come in and do the consulting. And what you've got down here is a kind of, you know, a thing that says, you pay us, so that one there, you pay us now, and we'll come and do some consulting for you, but we won't come in until next year or the year after. So it's a kind of, it's a prepayment from their client's perspective. So I think that's quite interesting. And you'll notice the other big current liability is this one here, this accrued payroll and related benefits. That is the staff compensation. So that is basically, I promised my staff, you know, a certain amount of money, and I now owe it to them as a bonus, for example. I haven't actually paid it to them because it's accrued as stock options, for example, and therefore I need to show it as a liability. So it shows as an expense in the income statement, and it shows as a liability in the balance sheet, but it doesn't obviously affect their cash flow at the time that it's awarded, because if I give you a stock option, it's just a right to buy the shares at a future point in time. It doesn't actually cost me anything in terms of cash flow. So you'll see that we expect pretty significant cash flow for these guys, and that's gone up by what, 1.7 billion, for example. So, you know, we're seeing an increase in that kind of that bonus liability, so to speak. There's the balance sheet, and then the equity. If you were to, you know, theoretically put these guys into liquidation, you'd sell off the assets, put them all on eBay, pay off the liabilities, you'd end up with about 20 billion left over. And I do emphasize the word theoretically in that, because it doesn't really work in practice. So 20 billion, and of that 20 billion, it's basically about 11 billion of invested capital and retained earnings of about 14 billion. Okay, so 13.988. So these guys, you know, they're making profits. You know, really, if we look at these numbers here, you know, they're making a profit and they are reinvesting. We've seen they're paying out a cash dividend. So they are distributing some of that profit as a dividend, a substantial amount of that profit as a dividend, but then they are also reinvesting back into the business. Okay, so there's our balance sheet. Let's go and look at our cash flow. In fact, let's look at the movement in equity before we do that. So just so we can see that profitability. So this is kind of 2 years ago, this is last year, and then this is the year under question. So the retained earnings, there's the retained earnings at the beginning of the year. Let me just get that up and running. So there's the retained earnings. Retained earnings at the beginning of the year is actually on the bottom of the previous page. So there's the 12 billion of retained earnings. And then in the year, we just need to move this over a bit so we can see everything that's coming through. So we're looking at that retained earnings line here. And we can see that these guys, now this is quite interesting here. So first of all, I'm going to look, they're paying out dividends. Okay, so that's the first thing to note. They are paying out dividends. However, you know, they've earned 6 billion, they've only paid out 2 billion in dividends. And what they're using some of those earnings to do is to cancel their treasury shares. Now, treasury shares are when they hold their own shares. So they're effectively, they've got some of their own shares and they're writing them off against the earnings. Now, this is the bit that I couldn't quite follow through totally, and maybe there's somebody who's watching out there who kind of understands this a little bit better than I do and can give me some clarification. But what you can see here is, so just looking over on the left hand side, this number here, we can see there's a share-based compensation expense and there's the issue of shares to employees. So those two numbers, I don't quite understand exactly how it kind of all fits together, how these numbers are all kind of circling together, but in a sense, in essence, you know, and you've also got here the purchase of their own shares, so or the cancellation of treasury shares, for example. So, you know, effectively what they're doing is they're buying their own shares and then giving them to their employees when their employees exercise their share options. And it looks to me like that is having a diluting effect on the number of the shares. So, you know, what we see with this company is that it's just producing more and more shares, and that's kind of the way it compensates its employees and keeps them on board. So it's just to be aware of that aspect. And this means that because of that kind of approach to compensation, just scroll that a little bit, that approach to compensation, if we look at the cash flow, which is, let's just find the cash flow. So here's the cash flow. So what we see is that they are, you know, they're generating lots and lots of cash. Now, even before the compensation, they'd be generating lots of cash. But what we can see is the, you know, so this accrued payroll, for example, that has a positive effect on their cash flow because they are, you know, effectively, and you see the same up here. This is the share-based compensation. Okay, so share-based compensation is an expense. It's in the profit and loss account, but it hasn't cost them anything in cash, so they add it back, and then they've actually got to go out and physically buy those shares. And so what we see a little bit further down is there's the business acquisitions. You remember we saw the goodwill. These guys, you know, the goodwill was going up, and I speculated that they were buying businesses, and they are. They're investing in the future. 4.3 billion. Obviously, there's a very little capex because, you know, a couple of laptops need replacing, but that's pretty much it. Maybe somebody's new desk, but, you know, there's not a lot of capex going on in these guys. So most of the cash from investing will be buying additional businesses. And then we see here the proceeds from issuing shares and the buyback of shares. And I guess the net effect of that is them buying back their shares and then using those shares in order to pay or give them to their employees who are exercising their stock options. And then we see the cash dividends that they're paying out here. So the net effect is that, you know, they're generating 9 billion in cash. They spent 4 billion on buying businesses, basically, to plug into the kind of, you know, the big Accenture kind of, you know, network, so to speak. And they've used 5 billion in financing. Of that, 2.5 billion is basically paying dividends to the shareholders, and 2.5 billion is the cost of, as far as I can make out, the cost of running their in cash terms of running their bonus schemes and the share option schemes for the employees. There is our kind of, you know, our you know, the key numbers. There's nothing really jumping out at us. You know, we're not going to talk about EBITDA because it's irrelevant to these guys. They've got no debt, so there's no gearing problems. Liquidity is all looking very, very healthy. Working capital requirement is irrelevant. You know, strong cash flows, strong dividend cover. You know, they tick a lot of boxes. So let's go back and look at as we mentioned earlier, Mo, we go and look at the share price and see how it's been performing. So quite interesting, the share price, you know, a little bit of a tank here. So this was obviously the pandemic, early 2020, when everybody's kind of, you know, and then these guys, you know, I mean, you know, a lot of companies suddenly said, we need somebody to help us out. And Accenture is, you know, well poised to do that. And so, you know, these guys, you know, they've seen a steady meritocratic rise in their share price. Peaked up here, and since it's actually been on a bit of a decline. Now, you know, good question here is to kind of, you know, is it cheap or is it expensive? Usually we look at a PE ratio, this number here, to see, you know, it's trading on a multiple of earnings, but for some reason, it doesn't come up with a PE ratio, and I don't know why, but I've calculated the PE ratio based on the market cap of 178 billion and the net profit. You remember the net profit is about 6 billion. And that means that these guys are trading on about 30 times earnings. Now, 30 times earnings, if you turn that upside down, that's about a 3% yield. That's expensive in my book. I mean, you know, these guys, you know, they're obviously, you know, doing pretty well, but it is expensive for a company where, you know, the assets, I think, Moed, we were discussing this just offline, you know, the assets of this company are basically the people. And if they lose their people, you know, there is no business. Now, they have very strong incentive schemes to keep the best people within the organization. But even so, 30 times earnings, you know, I kind of, you know, even on the if you're buying for the cash dividend, you're only getting a 1.3% yield. And you know, inflation, you know, we look at the kind of, you know, the rise in energy prices, you know, anything which is not an absolute must to is going to get, you know, these guys are going to get squeezed, I think. So I'm not convinced that I would be, you know, rushing out to buy these guys, if that makes sense. Now, that's not to say that they might not be a long-term investment. And if I was working there and somebody was awarding me these stock options, hey, I'll just be sitting there thinking this is fantastic. Now, you'll notice, obviously, that if you've been awarded stock options at the end of 2022 and your stock option exercise price was here, that means that your stock options are now underwater. So if you are working at Accenture, for example, your stock options are now underwater, which basically means that, you know, you have the right to buy the shares at 400, but they're trading at, let's say, 300. You're not going to exercise. Now, that's going to save the company a lot of money, but that also means that it's less incentive for people. They don't have to say, I have to stay here in order to get my stock options. Maybe, you know, there's an alternative. Maybe I can go and see EY Consulting, for example, and maybe I'll get a better deal from them. So you know, it's kind of caveat emptor, I think, is the story from there. So there you go, Moed. Not really for me, I don't think. I may be wrong. I've been proved wrong in the past, rather too many times, by the way, and I'll be proved wrong again in the future. But that is my take on Accenture.
Yeah, and it's important for people to be able to read those financial statements, and that's the purpose of these videos. So I think we've done a really good job there, and definitely worth, you know, making sure that, you know, we talked about this and you mentioned it now. The assets really are the people, and these kind of companies are going through a talent war at the moment, especially with wages still going up. And you know, share options is one of the incentives, particularly for senior people, right? And I coach a few of the partners and senior people in companies like this, you know, and share options are one of the major incentives to attract high quality talent. And certainly the more senior they are, the more options you're going to give them. So bear that in mind when you're analyzing a company like this or any other professional services firm. Look at the wage prices that are going up and also the war on talent, right? So how are their competitors trying to attract those people, and what prices are they setting to do so? So great analysis there, and would love to hear comments from people who are in the industry, or any comments from those that know about this business and willing to share that with this community. And if you have a company that you would love for us to help you analyze their financials, do leave a note in the comment section and leave some information behind why you're interested in this particular business. The more information you give us, the more interesting we'll find it, the more interesting, the more likely we will advance your request. So until the next video, thank you, Ted. Thank you, everyone else.
Good to see you, Marie. Catch you later.